Hello friends, welcome to today's session. In today's session, we are going to be learning cash flow statement. Normally students feel that this particular cash flow statement is quite a difficult topic. Yes, initially you might find it difficult, but if you practice in a systematic manner, you will start finding that cash flow statement is not that difficult. It is quite simple. So in today's session, I'm going to tell you how to prepare a cash flow statement with the given balance sheet of a company. Now let us look at this. The first step that when you go prepare a cash flow statement is first read the balance sheet of the company thoroughly to see and grasp what are the items that are there in the balance sheet. Like in this case, this is a balance sheet of Thermal Power Limited, and here you find there is equity and liability, shareholders fund, we have share capital, reserves and surplus, non-current liabilities, under that we have long-term borrowings, current liabilities we have trade payable and short-term provisions. Only these money items. Now as we move further, you find that individually if you look, share capital has increased from 11 lakh, it has increased to 12 lakh. When there's an increase in share capital compared to previous year to current year, it means during the year, this thermal power company has issued shares. So on issuing shares, what happened? Money flows in. So there's an inflow of money into the company in the form of proceeds from issue of shares. And this, you need to know that it is a part of financing activity. So in financing activity, you would show it as an inflow. Second, the reserves and surplus, it was 2 lakh which is changed to 3 lakh. This particular thing you will have to refer to the working note and see what are the different items which comprises and totals up to this particular amount. So we will come to that when we go to the notes. The next one we have is under non-current liability, we have long-term borrowing. Long-term borrowing has increased from 1 lakh 70 to 2 lakh 40. This basically means that during the year you have further taken loan. So whatever is the difference, that is the amount of loan taken, money has flown into the business in the form of loan. So this is also part of your financing activity and inflow in the form of loan amount. Finally, under current liability, we have the trade payable and short-term provisions. Now, here these are part of your working capital changes. If you're aware of the format of the cash flow statement, you would know that there is a particular part in the operating activity where you note the changes in the working capital. Working capital comprises of current assets and current liabilities. So whatever is the changes that take place, that is recorded in that part of the operating activity. Now we add whenever there's a decrease in current asset or increase in current liability, and we subtract the opposite, that is increase in current asset and decrease in current liability. So when we look at this trade payable, it has actually decreased, which means actually you have paid off some of the trade payable. So money has flown out. So that is a decrease, outflow. So it is under the less category that you would write trade payable. Similarly, short-term provision. Now here in this question, there is no explanation, there is no note which gives detail about short-term provision. So we would consider it on par as the current liability, and the change here is a decrease. So decrease in current liability is a less item in the working capital changes. Sometimes in some questions you have a reference to working note and there you find the detail, like it might be related to provision for tax. So in those questions, you might have to prepare a provision for tax account and find out what is the tax paid or the provision for the current year to appropriately incorporate it in your cash flow statement. But in this case, we just take it as a decrease in current liability as a part of a working capital changes. So I hope so far it is clear. Now moving further on the asset side, if you see, there's two categories of non-current and current asset. Under current asset, we have fixed asset, tangible and intangible. Again, notes. We will go and refer to that in detail to see. On the top of it, if you see, there is an increase in the tangible fixed asset and decrease in the intangible asset. Now going to the current asset, we have current investment, inventories, trade receivable, cash and cash. Very important important point is these current investments will be a part of your cash and cash equivalents. So when in the cash flow statement, you add the cash and cash equivalent at the beginning and write the cash and cash equivalent at the end, you need to include these current investment in the cash and cash equivalent. So you can prepare a note to calculate cash and cash equivalent as addition of current investment and cash and cash equivalent. If you have any investment which says within bracket marketable, that also means it is a part of cash and cash equivalent. Other than that, you have inventories and trade receivable. This is also a part of your working capital changes in your operating activity. You have to see whether there is an increase or decrease. These are current assets and inventories have increased. So when there's an increase in the inventory, then what happens? It is the item of subtract. You have purchased more, so there's an outflow. That is how the inventory has increased. Trade receivable has also increased. So which means you have not got an inflow. You are still supposed to receive more amount. So that difference is also similar to an outflow. So it would be a subtract. So on the face of it, when we saw, most of the items are all related to working capital changes were all subtract. So while writing the format, we will put only for the less item. We don't have to leave space for the added. So once this part is clear to you, moving further, now I want you to look at the notes to accounts. The first note was in reference to the reserves and surplus. Looking at that, you find that it has changed only related to surplus, balance, and statement of profit and loss. There's no other item. Sometimes you might have securities premium reserve, you might have general reserve. So when you come across that, you should know how to deal with it. Like if the change in the reserve, certain amount might be transferred to reserve. That is why it has happened. Or securities premium reserve might have gone up when there's issue of shares issued at premium. But here in this case, it's quite simple. You have just a surplus. So this would be the starting point of your cash flow statement in operating activity. The difference in surplus would be taken as a starting point. Now going into the tangible assets, the detail given here is it consists of machinery less accumulated depreciation. And also if you look at the additional information, there is something related to the machinery. So they have said a piece of machinery, the cost of which was 24,000 and on which accumulated depreciation was 16,000, was sold for 6,000. So from this we understand that we will be preparing machinery account and accumulated depreciation account as a part of working note to ascertain certain amounts to find out what will be the depreciation that has to be charged, which is a non-cash expense. Non-cash expense as a part of your operating activity is added. You will be able to find out, you have the sale value of machinery, you might have some purchases which you might get as balancing figure in your machinery. So for that purpose, we will be preparing the machinery account and the accumulated depreciation. And finally, the third working note was related to goodwill and you find that is decreased. So goodwill, if it is increased, it means you have purchased goodwill, so there will be outflow. Purchase of goodwill would be a part of your investing activity. But here, in this case, there is a decrease. When does goodwill decrease? Goodwill is an intangible asset would decrease when it is amortized. So here 72,000, the difference is goodwill amortization, which will be part of your non-cash and non-operating expenses, which is a part of your operating activity. So this way, through the first reading, I have noted down mentally that these are the items that I'm going to deal with in my cash flow statement. Once that is done, you prepare the format. Step number 2, prepare the format. Prepare the format for an entire page. Write in the books of the Thermal Power Limited, the name of the company. Cash flow statement. If the year is given, you can write for the year ended so and so. There are just 3 columns. One particulars column where you write in the detail and 2 amount columns. Now I will show you how to prepare the format. From the reading, whatever we have deciphered, we are going to prepare the format. A, first main heading is going to be about cash flow from operating activities. So under this, we are going to have the first, this is the main heading. Under this, it starts with the net profit before tax and extraordinary item. Now here, because there was just difference in surplus which was to be taken, we are not going to prepare a separate working note. We will just write the closing surplus minus the opening surplus as the difference. That amount would be taken into here. After that, in the format, if you see, if you remember, there is going to be depreciation related to machinery and goodwill amortization, which was there, and there was a sale of machinery. You have to compute whether there was a profit or loss. So there is going to be certain items related to adjustments related to your non-cash and non-operating items. So as far as I remember, there's depreciation, goodwill amortization. So I would be adding those non-cash expense and non-operating expenses or losses. And I will leave, say, 3 lines for it. So if there is a gain, then that would be subtract. So I leave 4 lines for this. And what I get, 1, 2, 3, 4. So what I get is called as operating profit before working capital changes. So whatever amount you arrive at is operating profit before working capital changes. To this, what you will do, you would add and subtract the working capital items. From the reading, what did we understand and what did we note down? That most of the items which were there related to trade payable, trade receivable, inventory, all of those were short-term provisions were all subtract. So I would just write the subtract part. What is subtracted? Whenever there is an increase in current asset or a decrease in current liability, then that would be subtracted. If there was a decrease in current asset or increase in current liability, that would have been added. So leaving space for that, at least 4 items were there. So 3 here, I go further, I leave 1 more line here for that. So what balance that I would be getting will be called as cash flow from operating activity. Now here basically, if tax detail was given, then we would have written cash flow from operating activities before tax less income tax, then cash flow from operating. But in this question, all those is not there. That's why cash flow. Now again, instead of writing cash flow, you can also write cash generated or used from operating activity. But as we don't know whether it is going to be negative or a positive amount, I'm just using the word, a neutral word, cash flow from operating activity. If it is a positive amount, you call it as cash generated from operating activity. If it is negative amount, it is cash used in operating. Now next we have is B. This related to cash flow from investing activities. Now if you remember, investing activities means those items related to your long-term assets and non-current investment. In this case, we had those fixed asset machinery, which there was a sale and there might be a purchase as well. So at least 2 items are going to be there. So I leave 2 lines for that. So 1 more addition line, and there's nothing else I remember related to investing activity we had. So we can move further and put the third cash flow from financing activity. Now in the financing activity, as far as we have gone through the question, there was issue of shares, we remember, and there was a long-term borrowing and it had increased. So at least there are 2 amounts. So again I will leave around 3 lines and I would put the next subdivision, that is for net increase, or they can be, if it is in a bracket, decrease in cash and cash equivalents. Now, to this E, we add the cash and cash equivalents at the beginning. And finally, F, we would arrive at the cash and cash equivalents at the end. And that is the end of our cash flow statement format that we'll be preparing. So this way we have prepared the format. Now let us go back, look at the question and start filling in the details and prepare working note. So going back to the question here, we will do it systematic. Start with the liability side. First one, share capital. 11 lakh increased to 12 lakh. Issue of shares of 1 lakh has taken place. So you go to the financing activity part and write proceeds from issue of shares. It's an inflow of 1 lakh. Next, we have the reserves and surplus that we saw in the notes to accounts. It was related to the surplus here. So that would be the starting point here. Closing minus opening, which was 3 lakh minus 2 lakh. That comes to 1 lakh. So that is where we are starting our cash flow statement from. Going back further, next is long-term borrowing. We found that from 1 lakh 70 it has increased to 2 lakh 40, which means an increase of 70,000 in the loan amount, which means during the year 70,000 extra was taken as a loan. So there is going to be an inflow under financing activity. Right there, money raised from long-term borrowing. They have not specified. If specifically given, you write that particular, like bank loan or debentures, so on. And there was an increase of around 70,000. So there was an inflow of 70,000. Now going back to the question, we have the current liability, trade payable. Trade payable has decreased from 2 lakh 4. It has decreased to 1 lakh 70. What 79? What is the difference? 2 lakh 4 minus 1 lakh 79. So there is 25,000 decrease. Decrease in current liability is a subtract. So we write here, we write there is a decrease in trade payable of 25,000. So 25,000 is a decrease. Now going further, last item on the liability side is a decrease in short-term provision of 27,000. So again it's a decrease. So we write it in the subtract short-term provisions. Decrease was of 27,000. Now going back, the liability side we have taken care of systematically. Now we go to the asset side. In asset side, if you see this tangible asset note, so looking at that, we have here that machinery was at this value 10 lakh, increased to 12 lakh 70, and accumulated depreciation was 1 lakh 50, increased to 2 lakh. Now for this purpose, we will have to prepare an account. So like this, in the working note, you prepare the machinery account. Particulars, rupees, debit and credit on both the side. The machinery account would open with a opening balance on the debit side to balance brought down. The amount was 10 lakh and it would close out with a closing balance on the credit side by balance carried down, which was at 12 lakh 70. Now accumulated depreciation, the opening balance is on the credit side. So on the credit side, you will write by balance brought down. The amount was 1,50,000 and you had a closing balance to balance carried down, which was 2 lakh, which is given in the notes to accounts. Now, what are you to do. That part has been noted down. We go back to the question. So this part we noted down into the account. Now for the next, we will do this and then go back to the additional information once we have finished with the balance sheet. Now, intangible assets, goodwill, this is goodwill amortized to the extent of 72. So that comes here. So you would have under the operating activity, goodwill amortized 72,000 as an amount, positive amount here. So now with that, we have finished the tangible and intangible asset amounts related to this posting. We still have the additional information to be incorporated in the machinery account. Next, we go to this current assets. Current investment, cash and cash equivalent. We'll prepare a note for that. I prepare the third working note, cash and cash equivalent. You can incorporate it in the cash flow statement only, but you can also do it like this at the end as a separate working note as well. Now, in that they have given two amounts. Current investments, that was at 1,50,000 was the opening and the closing was 2,40,000. And cash and cash equivalent, which was given at the beginning, was 3,75,000 and the closing was given at 3,20,000. So just total this up. 5,25,000 and that was opening, and 5,60,000. Now remember this would be written in the cash flow statement. So in the cash flow statement at the beginning was 5,25,000 and the closing was 5,60,000. So if you watch these two, it means the cash equivalent has increased by 35,000. So there should be a net increase of 35,000. Then only it will become 5,60,000. Now this we just noted down. Once we finish the cash flow statement and total up the three activity cash flows, it should be equivalent to 35. Then it means that we have done the question correctly. Now, having taken these two items, we are left with just inventories and trade receivable. Here, trade inventories has increased, trade receivable has increased. Both are current assets which have increased, which is a subtract. How much is increase? Inventories by 8,000 and the trade receivable is by 27,000. So we will write it down here. Increase in inventories, which was rupees 8,000, and I will write the other increase here. Increase in trade receivable, which was 27,000. So with that, we have incorporated everything on the asset side as well. And we have taken this surplus difference. These things we have noted down in the accounts, and the goodwill we have amortized. What we are left with now to deal with in hand is just this one piece of additional information. That is, during the year, a piece of machinery costing 24, which means in the machinery account, in this particular 10 lakh includes 24,000, on which accumulated depreciation was 16, which means this particular 1,50,000 opening balance includes this 16,000. And they sold it for 6,000. So now basically going to this account, you know from this that you have sold it for 6,000. So there is an inflow by bank account, sale, you have 6,000. Now they said the cost of that particular thing was 24,000, but the accumulated depreciation related to that was 16,000. So this 1,50,000 includes 16,000 that has to be removed. Whenever an asset is sold from the accumulated depreciation account, we take out the depreciation, put it into the asset account. So we will transfer it to the machinery account. Therefore, it will come on the credit side like this, to accumulated depreciation account, transfer of the 16,000. Now, further in the detail to calculate, see the cost of that machinery which was sold was given to be 24,000. And they said related to that the accumulated depreciation was 16,000. So from this what do we understand? That the book value on date of sale was 8,000. So with that we compare it with the sale value. They said it was sold for 6,000, which means you have sold it at a loss of rupees 2,000. So now this information will incorporate into the account first. So there is a loss. We have recorded the accumulated depreciation, transferred it, recorded the sale. Now we have to record the loss. The loss would be debited to the statement of profit and loss account. The loss on sale of 2,000. So this way we have put these amounts into this. So if you see, if you total these three amounts, 22 plus 2, 24, that was the cost. So automatically from this 10 lakh, the cost has gone out. 6,000 has come in the form of sale value, 16,000 in the form of depreciation accumulated on it, and 2,000 in the form of a loss on sale. Once this is completed, we can close out the accounts. The first machinery account will close out. We'll total it. 24 plus 12 lakh 94,000. Write it on the other side. This debit side, find the difference. That is 2 lakh 94,000. So this is represented by the purchases of machinery made during the year. So that is the balancing figure which we were trying to find out by preparing the machinery account. Now we'll close out this particular accumulated depreciation account as well. 2,16,000. Put it on the other side. Find the difference. The difference would be 66,000. So this is represented by the depreciation for the year. So this is the balancing figure related to depreciation. Now, having understood this, now what are the items will go in which place of the cash flow statement? Now, the purchase would go as an outflow in investing activity and sale would be an inflow in investing activity. This loss on sale would be in the operating activity under the non-operating losses that would be added back. And this depreciation would be taken as a non-cash expense under the operating. So these are the 4 places and 4 items that are going to go from here, this account, into the cash flow statement. So first let us take into the investing activity the outflow and the inflow. So going here, I'm going to write purchase of machinery 2,94,000 and sale of machinery, you get an inflow of 6. Sorry, this should be in bracket and this would be without bracket because it's an inflow. Purchase of machinery was an outflow. Now, the other thing was depreciation, which is a non-cash expense. So I write here depreciation amounted to around 66,000 and there was a loss on sale, which is a non-operating loss. So loss on sale of machinery, which was 2,000. So this way we have incorporated all the amounts. We have taken items systematically from the balance sheet and incorporated it. The notes to accounts we have taken into the respective places and the additional information we have incorporated. We're done with it. Now just do the calculations correctly. These are the items of add it up, put it in the outer column. So it is going to be 3 and 1 lakh 40. So we add it up here. So you get 2,40,000 as the operating profit before working capital changes. Now these are the items of 25, 27, 8 and is one more 27. So 27 plus 27, 54. 54 plus 8 is 62. 62 plus 25 is 87. So 87,000 we are supposed to subtract. Subtract from what? 2,40,000. So from 2,40,000, you subtract 87,000. So you will get 1,53,000. So this is the cash flow from operating activity. Now total this up and see. So we get an outflow of 2,88,000. So this is called as cash used in investing activity. And finally, last one we are going to have is this as an inflow of 1,70,000. So this is nothing but your cash flow from or cash generated from financing activity. Now all you have to do is total these three up. 1,53,000 plus 1,70,000 minus 2,88,000. If you take the total of these three, it would come to 35,000. So that shows you that your cash flow statement is absolutely correct. So I hope with this you have understood how to prepare a cash flow statement. Now as a self-assessment question, I have posted one of the previous year examination question here. It's a balance sheet of DCX Limited. Details are given here. Similar type of adjustment is there for the related to machinery. Please do try solving this all by yourself, and I'll be posting the solution to this particular question in the next video, that is tomorrow. So I hope it was a useful session to you. If you like the video, please do like and share this video. And if you have not yet subscribed to the channel, please do subscribe to the channel and support us. So thank you. Have a great day.